The dollar is under pressure. The US bond market is sending alarming signals. And now a new twist has been added to the mix. Trump has imposed a massive tariff on imported gold. The very real money itself is now under attack. This step is not just another trade measure. It's about how Americans will be able to protect their savings, and it has already triggered a shock reaction on global markets. We are witnessing several crisis processes converging at one point. The bond market, the foundation of the entire US borrowing system, is beginning to show cracks. Long-term debt auctions are underperforming. Yields are rising, making loans more expensive for everyone, from families looking to buy homes to companies planning to expand. At the same time, tariffs are being extended to more categories of imports, straining trade relations and pushing domestic prices higher. And the timing could not be worse. In 2025, inflation remains high, interest rates are not coming down, and economic growth is slowing. Government debt has already reached a historic record, and instead of easing the burden, new measures only make matters worse. The combination of financial pressure, geopolitical tensions, and now a direct hit to gold imports creates a dangerous feedback loop that could reshape the role of the dollar and the balance of power in the global economy. So let's break this down. The US government debt market has just sent one of its clearest warning signals in years. At the most recent auction of 30-year bonds, demand was weak. Yields rose to nearly 4.9%, the highest in more than a decade for these securities. Long-term investors, who usually buy such bonds for stability, are stepping back, and they are the backbone of financing America's massive debt. The 10-year bond auction, considered the benchmark for borrowing costs, also brought no optimism. Yields climbed to around 4.28%, with demand coming in below forecast. This matters far beyond Wall Street. Mortgages, credit card loans, auto financing, all of it is directly tied to the yield on 10-year bonds. When that yield rises, life becomes more expensive for millions of Americans. According to Treasury Secretary Scott Bessent, new bond issues are now going mostly toward paying off old debts, like a snowball that keeps growing. And to keep the government running, the Treasury is increasingly relying on short-term securities. Just this week, it plans to sell $100 billion in 4-week bills, the largest amount since 2023. For comparison, before 2020, such sales usually hovered around $40 billion. History shows that such spikes, like in 2009 during the financial crisis, or in 2020 at the peak of pandemic spending, always signal severe stress. The more the US depends on short-term debt, the higher the risk that a sudden jump in interest rates will shake the entire system. One shift in investor sentiment, and the cost of borrowing could soar, intensifying pressure on households already struggling with inflation and high prices. This is a tightening loop, laying the groundwork for the next major economic shock. Tariffs are often presented as a way to protect jobs, but in today's global economy, they quickly backfire. When the US raises tariffs, foreign governments don't stay silent. They cut purchases from American companies, seek alternative suppliers, and strengthen ties with Washington's rivals. In 2025, this is especially evident. Major buyers like India, Brazil, and South Africa are actively striking deals within BRICS, replacing US goods with cheaper alternatives from China or other developing countries. From machinery to agricultural products, orders are falling. For American farmers, factories, and exporters, this means fewer contracts, declining production, and ultimately layoffs. The revenue from tariffs that Washington collects does not come close to covering the damage. According to the Treasury Department, these inflows offset only a small portion of the budget deficit. The rest is covered through the same short-term borrowing. It's like living on a credit card that needs to be paid off every month. Such a setup works only until interest rates start to rise. If investor confidence wavers or foreign buyers further cut their holdings, the cost of refinancing will spike quickly. As a result, the tariff war makes the United States more dependent on short-term money and alienates markets that once were the main consumers of American exports. And as trade flows shift away, the pressure on domestic prices and household budgets only intensifies. For millions of Americans, the tariff war is not an abstract policy. It's a reality they face in grocery stores. A recent survey showed that 53% of families cite food prices as their main source of stress. The reason is clear. Imported goods like coffee, fresh vegetables, and fruit are now subject to additional tariffs, which pushed their prices higher. The original idea was to stimulate local production, but American farmers have run into their own challenges. Since 2024, the costs of fertilizer, fuel, and equipment have risen sharply. This price growth is tied to higher global energy prices and disruptions in supply chains. These expenses are directly passed on to consumers, so even products labeled "Made in America" are becoming more expensive. But the rise in prices is not limited to food. Housing costs remain near record highs, and mortgage rates continue to track the elevated yields on bonds. Utility bills are climbing due to volatile energy prices. Medical expenses, already the highest among developed nations, are growing faster than wages. Today, the average American household spends more than 1/3 of its monthly income just on housing and groceries, leaving little for savings, debt repayment, or anything extra. This financial pressure is changing people's behavior. Families are buying fewer fresh vegetables and fruit, postponing home repairs, and skipping routine medical checkups just to make ends meet. Retailers report that customers are purchasing fewer items per visit and coming in less often. This is a direct sign that people's disposable income is shrinking, and the effect ripples through the entire economy. When households cut spending, local businesses feel it immediately. Restaurants lose customers, service companies get fewer orders, and the economies of small towns begin to slow down. Inflation is no longer rising as fast as it did in 2022, but its accumulated impact hasn't gone away. For the average American family, the pressure is only increasing, especially amid a prolonged trade war. Yet Commerce Secretary Howard Lutnick insists that these tariffs are being paid by the whole world, except Americans. The statement sounds strange and clearly shows the kind of logic currently driving decisions in Washington. And now that same logic has reached one of the oldest and most trusted assets in history: gold. It has always been regarded as the ultimate store of value, real money beyond the control of central banks, interest rates, and political promises. And now it is in the crosshairs. The Trump administration has imposed a tariff on imported gold, particularly on bars weighing 1 kilogram and 100 ounces. The new duty will raise the cost of gold for American buyers by nearly 39%. This is a huge jump for a market where margins are already slim. In 2024, the United States imported about $16 billion worth of gold. The main suppliers were Canada, accounting for 28%, Switzerland with 13%, and Australia with 7%. Now, for many American investors and jewelers, these shipments will simply become unaffordable. The market is already reacting. U.S. gold futures have surged to record highs, and the gap between U.S. futures prices and the global spot price has reached about $120 per ounce. This is the largest divergence in many years. As a result, Americans are now paying significantly more than buyers in Singapore, Hong Kong, or Dubai, where gold sells almost at the global benchmark without any tariffs. By making gold more expensive and less accessible domestically, the United States risks cutting its investors off from one of the most reliable ways to protect against financial instability. Against the backdrop of this new policy, the question becomes increasingly pressing. Who benefits when the most trusted form of money in the world is taxed and placed out of reach of its own citizens? Tariffs on gold may hurt American investors, but for China, they are a gift. Falling demand in the United States means more of the world's supply will flow to Chinese buyers, both private and state-owned. For Beijing, this is not just about buying raw material, it is a strategy to expand strategic reserves. Since the beginning of 2023, the People's Bank of China has already added more than 300 tons of gold, and the new market conditions make it possible to buy even more, often at favorable prices. In essence, the tariff designed as a source of revenue is accelerating a global realignment, one in which America's role as the world's financial center faces its most serious challenge in decades, and its competitors are ready to step into the vacant space. Meanwhile, the U.S. debt burden is not just growing, it is compounding at a pace that is becoming increasingly difficult to control. Even if the Federal Reserve cuts rates in the coming months, the sheer scale of borrowing means it is unlikely yields will fall enough to significantly ease the pressure. America is increasingly financing itself through short-term debt that must be constantly refinanced. This makes the entire system vulnerable to sudden spikes in interest rates or shifts in investor sentiment. Keeping more dollars within the country to fund this debt also comes at a cost. When fewer dollars circulate globally, the domestic supply grows. This excess liquidity does not stimulate the economy, it pushes prices higher. Yes, inflation has eased compared to the peaks of 2022, but core expenses for housing, food, and healthcare remain significantly above pre-pandemic levels, continuing to strain household budgets. The gap in PMI data tells the same story. While in most countries commodity and service prices are stabilizing or even declining, American producers and suppliers continue to report rising costs. This gap clearly shows how tariffs, rising borrowing, and trade isolation are creating a higher cost environment in the United States compared to its trading partners. If this cycle is not stopped, it will erode the standard of living. Wages are not keeping up with price growth, savings are shrinking, and essential expenses are taking up a larger share of income. What we are seeing is not temporary pressure, but the beginning of a long-term structural decline that will be much harder to reverse once it takes root. The signs are already everywhere: rising bond yields, declining trade, gold flowing out of the country, and a debt machine that cannot slow down. Every lever pulled to keep the system running adds pressure somewhere else. At some point, that pressure will break something, and when it does, the impact will not be limited to Wall Street. It will hit every household budget, every bank account, and every paycheck. So ask yourself, does this strategy preserve America's strength, or is it slowly chipping away at it piece by piece? Share your thoughts in the comments and subscribe to the channel to follow how we approach the point where the system might start to crack. See you in the next video.